welcome back to Dukascopy TV. I hope you had a good weekend, and today we're going to have a look at speculation in the commodity markets. Well, we're constantly keeping a close eye on economic developments to gain an insight and outlook for oil and commodity prices. Well, UNCTAD firmly believes that finalization is the real root of oil and commodity price volatility. And on this subject today, I have Nicholas Maystre, and he is an economist at UNCTAD here in Geneva. Well, welcome today.
Hello.
So Nicholas, real economy explanations are currently dominating the debate. Now, why is this, and why do you think the whole financialization is kind of being ignored in a little bit?
Well, in fact, commodity markets have always been extremely volatile. If you look at the supply and the demand of those markets, they are very inelastic. Therefore, a small change in quantity, will trigger a huge impact on prices. And of course, there have been major changes over the last decades, let's say, regarding the fundamental market. We have weaknesses in emerging economies, so that has a strong impact on the demand and all that. Various explanations, although on the supply side, with some export ban in some countries and all those development. But in our view, clearly, the financialization of commodity market has to be taken into account if one wants to understand somehow the price development, and especially the volatility of those markets. So yeah, what do we mean by the financialization of commodity markets? It's basically the growing presence of financial investors on the commodities future market, and they enter those commodities market to basically diversify their portfolios. And of course, some of those markets are quite tight, and that might have a strong impact on the volatility and the price development.
And Nicholas, if we compare the evolution of oil and commodity prices during 2012 with that of maybe just say 10 years ago, we do actually see quite a dramatic change. Now I have two charts. Could you kind of please walk me through them and explain this to me in a little bit more detail?
Sure. So here on that chart, what we have is basically the price development over the first 8 months of the 2002 of three indicators. So in blue, you have the price development of the WTI, which is an index for oil in the United States. So we have somehow rebased everything. So those are index, but they are rebased in 100 at the end of the 1st of January 2002. So you have basically the price development of the oil over the first 8 months of the year. And then you also have the price development of the stock, the European stock market in the red line, and in between you have the Standard & Poor Goldman Sachs Commodity Index, which is a broad index for commodities. So those, and you can clearly see, at least if we compare, the stock market with the other two, because of course WTI, oil is part of the Standard & Poor and Goldman Sachs Commodity Index, but there is basically a very strong distinction between the red line and the other two lines.
Okay, I'll just show you the other chart here.
And if we somehow replicate this description in 2012, what we observe is now all the three indices moves exactly in tandem. And for us, that clearly reflects the impact of the financialization of commodity market. It's one pretty basic example, but the reason behind is that, of course, the fundamentals of the commodity market are not necessarily the same as the one from the stock market. And in particular, if we look at the oil market in the US, the elements that impact the demand or the supply differs from the one that really matter for the stock market in Europe. So therefore, in principle, we should not expect those two indicators to move in tandem. but that's what happened. And in fact, those findings relates to one of the study we have previously released, when we observed that the return on various commodity market, for instance oil, but also soybeans, corn, and various other soft commodities, moves exactly at the same time. The correlation of those return with the U.S. stock market are much higher since the crash of Lehman Brothers. And again, it's something that is hard to explain if we look only at the fundamentals.
And finally, Nicholas, just to finish things off, what are the main challenges facing commodity exporting countries right now?
So commodities exporting countries right now are experiencing a pretty good period, given the relatively high level of commodity prices compared to their historical pattern. And but nevertheless, those should not be a reason for not trying somehow to diversify further their economy. So commodities exporting countries should not become complacent about those high prices, because we don't know if they're gonna stay high for the next decade. And therefore they should, in our view, use the revenues of those commodities to promote the diversification of their economy, and also ensure that they manage to get a sustainable and inclusive growth. Yeah.
Thank you very much, Nicholas.
Thank you.
Well, viewers, I hope you enjoyed this interview. Coming up next, I'll be discussing financial planning with Mike Cody from Doireann Financial Consultancy Group. But for now, goodbye.